everyone, and in today's video for FAC 1502 we will be discussing the asset section of the Statement of Financial Position. Let's start with the definition of an asset. An asset is a resource controlled by the entity from a past event that will lead to future economic benefits. You get two types of assets: a current asset and a non-current asset. A current asset is anything that is less than 1 year, and a non-current asset is anything greater than 1 year. Alright, so what is a non-current asset? A non-current asset is an asset that is not expected to turn cash within 1 year of date shown on the company's balance sheet, which is the Statement of Financial Position. Non-current assets are a company's long-term investments for which the full value will not be realized within the accounting year. So you value non-current assets as greater than 1 year of having them. You do not plan to sell or exchange non-current assets in for any form of cash. That is why they are non-current. You plan to keep them, usually for a minimum of 5 years. Good examples of non-current assets would be the property, plant and equipment, where the company buys vehicles, equipment, machinery, and so forth. Another good example of non-current assets is intangible fixed assets. An example of an intangible fixed asset is a website or a brand. A website such as the UNISA website that UNISA uses, that is their intangible asset. And a brand name would be, for example, McDonald's. That is their brand name, that is their asset to them. If you hear about McDonald's, you know who I am talking about. That is their brand. Current assets. A current asset is a company's cash and its other assets that are expected to be converted to cash within 1 year of the date appearing in the heading of the company's balance sheet. Current assets, for example, are your debtors control, your inventory, your trade and other receivables, and your cash and cash equivalents. You will not keep current assets for longer than a year. Your current assets are supposed to be exchanged for cash within the year, so you are not expecting to keep them for a long amount of time. This is why inventory falls into that. A company like Pick n Pay, for example, has a lot of inventory in their warehouses, but the inventory is constantly being moved in and out because that's their day-to-day operations. They will sell it and convert it into cash, which will go into their cash and cash equivalents. An asset. In your Statement of Financial Position, your total of your current assets and your non-current assets will equal your liabilities, both non-current and current liabilities, plus your owner's equity.